Once upon a time in a land not so far away called ESG investing, the fairy godmother of the East made you sleep better because your investments didn't harm the environment, exploit people, or make puppies cry.
But the Wicked Witch of the West haunted your dreams like Freddy Krueger with low stock market returns and fears of retirement insecurity.
And then you woke, and now you're listening to Queer Money episode 440. And today we're talking with the co-founders of Till Investors and co-authors of the upcoming book, Sustainable Investing, an ESG Starter Kit for everyday investors, Kylelane Purcell and Ben Vivari, to talk about the evolution and value of value-based investing and how those low returns are now nightmares of yore.
Kyle and Ben have spent their careers in financial services and are on a mission to spread the value of financial, environmental, social, and corporate governance returns to the masses.
Ben and Kyle join us today to help lead us into the future of investing, so let's get on with the show. The mission of Queer Money is to financially empower the LGBTQ plus community. Join us in thanking Capital One for supporting that mission.
Welcome, Kylelane and Ben, to the Queer Money podcast. We're looking forward to this meaty discussion with you two today.
Thanks for having us.
Thank you.
Of course. And for our audience, Kylelane goes by Kyle for her closer friends, and we feel like we're friends with Kylelane right now. So going forward, we will call her Kyle.
Bring it on.
So here we go. So ESG investing was first ridiculed when it came onto the scene because it would offer low yields to people. And now it's getting ridiculed because apparently it votes Democrat. Why can't ESG investing ever find its niche and really win the day? What's the struggle there?
Catch a break.
Well, it's a great question. And it's a question that's on the minds of a lot of people. I mean, the truth is that as much interest as there is in this style of sustainable investing, it doesn't take much from our more conservative friends to kind of spook a lot of people into saying, oh, well, maybe we shouldn't be doing that. And, there's such a long history in the financial field. And I've been doing content and communications work in the financial industry for a real long time. I know you can't tell, but I've been doing this for like 30 years. And there's an intentionality about it. There's a lot of financial investment oriented people. They don't want people to really know all the details. They want it to sound complicated. They want the really big money people to really be in charge of how money is used, right? So, but I think the most important takeaway from all of that is that whatever feedback or negative blowback is happening related to ESG, it's not coming from the business world. It's not coming from the investment world. It's coming from culture warriors and politicians. And I think that's a really important point to make, because if you look at businesses themselves, businesses are very interested. This is about having access to better information. ESG is measurements, it's data about sources of risk and to identify business practices that do more harm than good in the long run. Businesses want that data. Investors want that data. So if you talk to the business world, they are all in on this stuff. It's just that political culture warrior world that it's not happening.
So you're saying that there's not really any validity to the polarization of ESG investing, that the yields are there or have started to become there, and maybe this should be something that people should consider more?
Oh, I definitely agree with that. There have been thousands of studies now on ESG, and there have been so many because there's such a sort of entrenched view that, caring about people and caring about social issues can't possibly make decent money. But it turns out that if you actually, that's all anecdotal belief by people who don't want that to be true. If you actually look at data, there was a good meta-analysis that we cite all the time from NYU Stern from, I think it was 2000 or 2020 or
Yeah,
I can't remember.
2020, something like that.
I think it was 2020. They looked at thousands of different studies that have been done about performance of ESG type investments, and they perform as well as or better than other types of investments, traditional investments. And I think the finding I found really interesting was that the longer a period you look at, the better the performance of ESG is.
Oh.
And if you're a long-term investor, which everybody is, this is a performance advantage that everyone should know about. Everyone should be free to take advantage of.
That is interesting. Two things there. I do like that you pointed out that the blowback really is coming from a very small group of people, politicians and individuals on the right, very far right side of the religious social spectrum. And whenever we see attention coming from either ends of the spectrum, oftentimes it's sensationalized, right? So we need to understand, is there truth in what they're saying, or are they doing this for some sort of attention or to appeal to a small group of, in some cases, very vocal and powerful people that will go spread the word. I do like that you point out this idea that ESG investing is better for the long term. I think back when I first started thinking about or hearing about, especially I think the environmental side of investing, we were looking at a lot of small startup companies that were struggling to get a foothold, and there wasn't a lot of appetite for making lots of big changes. But now there is that appetite, right? We see in countries like Germany, where 50% or more of their energy is coming from renewable resources. The companies that are involved in creating renewable energy are exploding because of that. So we do have to look at the data. If we're a smart investor, we have to look at the data. If we're an emotional investor, then it doesn't really matter, right? And so then we do need to be looking at the data if we want to make the right decisions for our finances as well as our financial future.
Yeah, it's worth remembering that like what you're citing is absolutely true. It's now, it all changes day to day, but it's now cost effective for businesses to switch to renewables rather than use fossil fuel. And, like I say, that may change moment to moment, but the larger point is that renewables are not more expensive or more problematic. They have their own issues, but whatever. Every time there's a winner in a game like that, there's a loser. So if companies are drawn toward, hey, we can open the door to renewables now, that means that the demand for traditional fossil fuels is going to go down. And it just so happens that the traditional industries are the ones that have quite a lot of money. So they're very motivated to be out there and trying to stall this progress as much as possible. I think it's one reason why it's happening a little faster in Europe than it is here, because in Europe there's a little bit less, there's a little bit more regulatory limitation around these companies trying to basically put their money toward these sort of political efforts.
There's a danger when the Luddites have all the money.
Yeah.
So there must be a marketing problem though for ESG investing, ESG funds, right? Because as we talked about before we started recording, we're going to be interviewing Carrie Schuffman from UBS in a couple of weeks, and they just came out with a study that showed that 79% of women say that ESG investing is appealing to them, and 3 out of every 4 expect the same returns with ESG investing as they do with traditional investments. But less than half of those same women are actually investing in those types of funds. So what's the disconnect there, and how can we bridge that gap? Maybe, I don't know, publish a book about starting ESG investing?
Boy, if only somebody would. I'll have to make a note about that. Yeah, so there is this huge disconnect between it's fascinating. Everybody wants to invest sustainably. Nobody invests sustainably. And I think there are a lot of different reasons for that. I mean, I think that, when you think emotionally about your investments, right, the first thing you want to do is you want to be safe, right? And doing anything that isn't the mainstream normal path that everybody is doing feels a little less safe. And your financial advisor is going to tell you, oh, that's not really all that safe, right? And so you have to sort of make this mental leap to say, you know what? I am a smart person and I can look at these numbers and I can decide for myself that this is where I want to put my money, right? And one of the things that the industry talks about right now, the ESG sort of industry trade group talks about is this concept of tracking error. Yes, your returns are going to be different than the plain vanilla, just buy me the whole index, right? But we're not going to tell you that they're going to be necessarily better or worse. They're going to be different. And if you're okay with that difference, then great. Let's find you some funds that align with your values. But that's not the message that they're getting from their financial advisors most of the time. Most of the time, the advisors are telling them, it's not as safe. It might be a little bit more expensive in fees, which is true, and that's another hurdle, right? And so for people who have for their whole lives been told that they're not the experts in investing, right? Put your money in this fund and don't look at it, don't touch it, don't think about it. It's a hurdle to say, well, look at it, think about it, maybe touch it, right? And so that's sort of what we're out here doing, is trying to give people sort of the self-confidence to say, no, there's not a wizard financial mastermind out here behind all the investments that has all the better data than you do. It's okay to have an opinion and, align your money with what you care about.
So just a kind of based on what you just said, it almost sounds to me like there's a possibility that advisors or maybe investors are just lazy. I don't want to take the time to have to learn something new to tell my clients that this could work for them. So instead, I'll just say that's scary. We don't want to do that, right? It kind of, it's so funny.
I don't think I would have put it exactly that way, but that's basically what I would have.
We don't have to be PC.
It is.
You might have to be.
Yeah, it is. It is kind of. In some ways, it kind of parallels being queer, right? People, once they get to know other queer people, they're like, oh, they're just people too, and they have the same wants and concerns and needs and desires just like me.
But I am a wizard.
No, you are. And I think that, kind of we need to say, okay, let's pull the covers back, or the curtain back, not the covers, but let's pull the curtain back on ESGs for more people. And that's probably what your impetus in doing this is, right?
Yeah. And so, we've been on a bit of a journey here, because in our day jobs, quote unquote, we work with a lot of asset managers, right? The people who are running the funds, and we're like, oh, we're going to help them so much with how they talk about this. And they were just not ready to talk about it. So then we said, okay, we're going to go to the advisors. They are going to be the ones who are really going to capitalize on it. And like you said, I mean, it's just, they see it as a job. They see it as another thing that they have to do. They're not going to get any more money out of it, right? And it's a lot of work. There's a lot of nuance. There's a lot of different funds that do a lot of different things, a lot of different ways. And for advisors, it's so much easier to just say, it's not as safe. Why don't we just trust me? I'm your advisor. Let's put you in this fund that I put all my other people in, and let's move on with our day.
Tired of all the credit card offers you get from your current credit scoring app? Download CreditWise by Capital One today to avoid them.
I think it's worth pointing out too that sustainable investing is a different concept about how to think about your money and what you do with it. It's not just like put your money into a business so you can extract value out of it. It's about put your money behind people that you believe are responsible and considerate in the way that they balance the needs of their various constituencies, their shareholders and their employees and their communities, right? It's a different way of thinking about what money is for. And I think people sense that, and that's appealing to them, but they don't really understand it all. So, there's a lot of space in here to try to help get people through that understanding to, yes, you can, in fact, use your money to support businesses that you think are better businesses that fit your values better without it being a ridiculous or foolish thing to do. But people need some proof points on that.
It would seem to me, if you're a forward-thinking advisor, one that's not at the end of your career, if you're a forward-thinking advisor and you see what's going on you know that there's going to be this massive wealth transfer from men to women, and then from generation to generation. And you look at what's happening with millennials, some Gen Xers, even some baby boomers who are now saying, I don't want to work for this company anymore because that doesn't align with my values. The more and more people are making decisions. A pandemic really pointed this out. More and more people are making decisions about what they do with their careers, with their money, with where they live. More and more are doing it based on how it aligns with their values. Why wouldn't you? Why wouldn't you want to have this as, for lack of a better way of saying it, a quiver in your, whatever that thing is? Yeah.
An arrow in your quiver.
Arrow in your
The
quiver.
arrow
There
in
we
your
go.
quiver.
Thank you. Right.
You could have
be able
another
to
quiver
say
back
to,
there.
you know,
Yeah, 2 quivers is better than 1.
That's right.
when you have this wealth transfer, you can ask these questions of these potential individuals who would say, I'm going to take the money elsewhere, and say, okay, what are your values? How can we align the investing that you're inheriting? How can we align this with your values?
I think the challenge is in what you just said. Unless you're at the end of your career, this might be an opportunity for you as a younger investor or investment professional. What 80% of the financial advisors are going to retire in the next like 20, 30 years, right?
Mhm.
They're all stale, male, and pale.
Right.
They have
Yeah.
no motivation to learn something new and to share that with their clients. So maybe that's the problem. I mean, I guess we'll throw that out to you. Is that the challenge that you're seeing with the marketing of ESGs, or is there some other dynamic at play?
Well, I would say first, there are advisors out there that do encourage sustainable investing. They're harder to find. There are a couple of networks out there that you can go and, I'm not going to, endorse any of them, right? But they are out there and they can be found. And it just takes a little bit of work. But also, the stale, male, and pale are also very entrenched, right? And, this wealth transfer that's happening, they are managing it, right? So their money, the old white guy dies, right? And his money goes to either his wife or his children, whoever it is. And the first person that his wife and children talk to is his old white financial advisor, right? And he's the expert and he knows what to do and he knows how to do things. And it can be a little intimidating, right? To say, sorry, guy that my dad trusted for 40 years, I'm going to go in a different direction. Right. That's when we go back to the talking about emotions of investing, right? It takes some balls to say that to a financial advisor, right? A trusted family resource.
Why should investors invest with their values rather than investing for the yields with the traditional style of investing and then buying based on their values, such as, whether or not I'm going to actually buy Bud Light or shop at Target, or why don't I just worry about that at the local level and let my yields stick with what the traditional returns are?
Yeah, I think that's a really good question. And I think it's a question a lot of people ask. In our book that's coming out in October, we talk about a concept called the ladder of impact. And the idea is that, rebuilding the way that you think about money and the way that you use money is kind of like a stepwise approach. So there's no reason that you kind of can't do both, especially when you consider that, there's no financial penalty. There's no, obvious financial penalty that comes from ESG investing. So, when you think about the ladder of impact, you can start with the concept of like boycotting, which is a great step to take to express your values. It's accessible. Anybody can do it. It sends a very clear message, and it's also very targeted to very specific reactions to things. You can not buy Bud Light because of the way that Dylan Mulvaney was treated, right? That's legitimate. And it's very specific. It's reacting to something very specific. Investing is less specific. It's bigger picture, but it's also taking that expression of your values to the next level. Most ESG funds, even though there aren't a lot of LGBTQ plus funds out there, most funds that are looking at ESG information, they're looking at inclusive practices in the way that companies hire, the way that they promote, the way that they lead, and the way that they interact with their communities. They're looking for transparency and diversity and other measures, like legitimate measures. So if you're investing in those types of companies, you're advancing the concepts, the concept of your values at a much higher level. It's a bigger picture, longer term kind of thing, but it's a very powerful kind of thing, because at the end of the day, if you don't buy Bud Light, that's a couple of bucks off of their profit, but off of their bottom line. But if you don't invest, and if a larger community of people doesn't invest, their key source of funding is cut off.
So that raises a question. It does seem to be a sort of an attack on that diversity and inclusion initiative, and that for the LGBT community has been something that's been very important for employment, where we actually do our shopping, but also with our investing strategy. So when you're considering ESG investing, how are ESG funds considering companies such as those being attacked for their diversity and inclusion efforts, such as Disney and apparently Chick-fil-A now? You can't eat Chick-fil-A. Nobody can eat at Chick-fil-A.
Nobody.
But the
It's good for the
line is
chickens.
endlessly long at the Chick-fil-A near us.
So are ESG funds considering all of this controversy and attacking accordingly?
Yeah, so there's a lot of different ways to look at it, but for my money, the best organization out there that is taking a holistic view of companies and their LGBTQ practices is one you guys are very familiar with, the Human Rights Campaign, right? And their Corporate Equality Index. And I think it's really useful to sort of look at, well, what are the questions that they ask, right? They send this survey out to thousands of companies. 1,200 companies responded. It's about 3/4 of the Fortune 500 responded. And what they ask is, do you have workforce protections? Do you have a policy that includes protections for sexual orientation, right? One that I think is really interesting is, do you provide inclusive benefits? So is there equivalency in the benefits you provide for same-sex and different-sex spousal and domestic partners benefits, right? That's really interesting. Do you provide health coverage for transgender individuals, right? And things that they might need. And then also things like, do you have, like a employee group? Do you have internal training on LGBTQ issues? All these different things. And so when I'm out there looking for, well, what companies are really, good in these areas, the Human Rights Campaign is probably the best place to look. And, when we talk about, the three big, hot button companies right now are Target and Disney and Anheuser-Busch, right? The parent company of Bud Light. And, Target and Disney, not only do they get 100 out of 100 from the Human Rights Campaign, but they're also sponsors. Right. So that's another way that they're showing you, yeah, we care about this stuff. Not only are we running ourselves in a way that is, really positive according to Human Rights Campaign, but we're gonna provide money to help them do their thing. Right. Because companies that don't respond to their survey, Human Rights Campaign is going to go out there and do the research themselves and figure it out so they can call them out. Right. So Target, Disney, they're providing money to help do that sort of stuff. Anheuser-Busch got 100 out of 100. But after the Bud Light incident, even the Human Rights Campaign didn't know what to do. They took them out of the index. They said, we're going to pull you guys out. Maybe you got 100, but this doesn't feel right to us, right? And so they said they've given Anheuser-Busch, I think it's like 3 months or something to respond. They haven't responded yet. But, it just goes to show you, even the experts, quote unquote, Human Rights Campaign, it's tricky to sort of figure this out and figure out how you want to, weigh all these different things.
Interesting. I didn't know that about HRC and Anheuser-Busch's current dialogue. That's news to me. Do you know how long ago they broached them with that?
I think it was less than 3 months ago because they gave him 3 months to respond. I'd have to go back and look at the timing of when everything happened, but there was a big, huge article, I think, in CNN all about, how the HRC is responding to this because it was a big deal.
I didn't see that. Interesting.
They'll probably respond on the very last day, right? Give their lawyers
Yes.
every single minute of time to craft the right message.
Whatever they say, conservatives are going to be furious.
Right. No matter what they say. Right.
Yes. This is a no-win situation for them.
But is it though? I mean, if the future of investing is sustainable investing and being good corporate citizens and all that, and we know that sort of the younger generations are more LGBTQ and LGBTQ friendly than the older generations, is Anheuser-Busch focused on the here and now and the bottom line? And of course they probably are, because it's all about the shareholder value from quarter to quarter, right? All we care about is the next quarter. But is that more short-sighted than they should be, rather than looking for the long term of who are our consumers going to be in 10, 20 years?
Well, then, so I'll point you to what Kyle said at the beginning of our discussion, right? That the longer term you go, the better ESG does. And this is a great example. You're right to question me in saying that this is a no-win situation for them, because I'm thinking of the news cycle. This is a no-win news cycle for them. Right. But if they have their eyes on the prize on, or where are we going to be in 10, 15, 20 years, then yeah, there's a win here if they're strong enough to take it.
Yeah.
Yeah, I would just point out that I had a conversation a while ago with an old colleague who is now working in the Chicago area, doing sort of like a foundation that is trying to help sustainable businesses in that city kind of find funding and thrive. And I asked him, like, they're relying on other people to provide them with funding. And I said, this is kind of a hot issue right now because it was the COVID times. But do you think that the interest in this will last? And his answer was that yes, because all of these companies are in this bind where, yes, their leadership is stale, male, and pale. I mean, that is pretty generally true. But the employee base is not. Right. The employee base in these companies, which is at this point up through middle management, they're all millennials, they're all Gen Z, they're much, much more diverse sort of cohort of people. They're much more interested in these concerns. They are asking very tough questions of their management, and they're quitting if they're not getting good answers. I mean, these are not little things that are happening. These are pretty big, substantial trends. And if you're a large company of any kind, your ability to be successful in the long term very much depends on your ability to understand these questions, answer them accurately, and respond in a way that your own employees, who know you the best, are paying attention to and are looking for. So, it does sort of seem to me that, a lot of companies are, the old guard that's sort of in charge or on the board, they're going to look at that news cycle and they're going to freak out, right? But if you're anywhere in sort of middle management or below, that the long-term game is something very different, right? So there's going to be change. It's kind of inevitable.
So I want to play devil's advocate, though, because I want to make sure that we're not being naive here. I like what you said, and I tend to agree with what you said, but there does seem to be a very loud minority on the other side of the spectrum. The leader right now seems to be Ron DeSantis, who wants to take away all the DE&I efforts. Slavery was actually great for everybody, especially Black people. If those and he's doing that because a percentage of his followers, maybe not necessarily as large as he would like, but a percentage of his followers want that. I just saw an article earlier today that Doug Mastriano is running for something. I don't know what he's running for, but he could be even crazier than DeSantis. Are we being a little bit naive, thinking that history will play in our favor socially as well as stock performance-wise, or do we think that loud pushback from the DeSantises of the world is going to get even bigger and take away all this?
Yeah, I don't think we're being naive. And the reason I say that is that when Microsoft puts multiple billions of dollars into trying to become a net zero company, and their CEO is putting out, annual reports to describe their progress on that in extensive detail, and is working very hard to develop data to sort of show what they're doing. They're not doing that because, the CEO of Microsoft is woke, right? That's not what's motivating that. What's motivating him is real business concerns, costs, risks, real stuff. And Microsoft has a much greater impact on your and my everyday life than Ron DeSantis does. So, I don't want to minimize.
The news would tell me otherwise.
Yeah, well, the news does, the news people aren't all that interested in like money stuff either. So, politics is way more exciting. Yeah, so I don't want to minimize it. I just don't think that it's long term. I don't think it can stick.
When you said that, what I thought back to in my mind, that I had to look it up here real quick, was the Martin Luther King quote that Obama used, which says, "The arc of the moral universe is long, but it bends toward justice." Right? And, if you believe in that, and I hope that people do, right, that ultimately something good is going to happen, and you're investing for that long universe, right, then it makes sense to invest in a way that you have some hope for the world, right? These culture wars are happening, but in the end, the good guys are going to win, right? And the other thing that I would say to that is exactly why you should invest sustainably, right? Because we care about where our society is headed. And, by not investing your money in a way, I call it's the unpulled lever, right? Here's the thing that you can do, right? No, you by yourself are not going to change the world, but you by yourself still recycle, still buy organic, still do whatever it is, right? This is another way that you can push our society to be what we hope it will be.
Yeah, I tend to agree with you. We interviewed Dominic Barton several years ago for a Forbes article. He was at the time the CEO of McKinsey.
Managing director, I think, is what they call them. You
I don't know.
what they had.
He was higher up than I ever got. And he
was
said
at the
if
top.
any leader who cares about bottom line growth needs to also care about diversity and inclusion, because the two go hand in hand.
Mm-hmm.
And I would guess that that's not just diversity and inclusion, but that's a lot of the values that maybe ESG investments and the companies that make up those investments hold: diversity, inclusion, fair pay, the environment, and all of that, right?
Mm-hmm. Go woke or go broke, baby.
Well, so where does that come from? If that's a catchphrase, is there some validity to go woke or go broke, or is it just a big lie? Like, Trump won the election.
I think it's a lot of scaremongering, right? I think that the industry did itself a tremendous disservice by calling it ESG, because that sounds like a scary 3 words that somebody's conspiring against me. I think we have to be honest with ourselves that, yes, for all of it's just a risk metric, and it's just looking at financials and there is a kernel of truth to yes, and we are also trying to, implant our values into this industry, right? And I think we have to be honest with ourselves about that. No, it is not the leading thing, right? No, we're not saying, throw all your money away at the expense of the environment. But there is some corners of the ESG world where, it's called impact investing for a reason. You're trying to have an impact beyond just what your financial returns are going to be. It's not all of ESG. There are many people out there doing ESG in a way that is purely looking at financials and metrics and risk. But of course, the political side is going to look at the most extreme version of this and say, well, that's what everybody's doing. They're all trying to push their woke policies on me, and now I'm a victim, and you should think you're a victim too.
On the flip side of that, there is a lot of truth to the go woke or go broke concept. There's a lot of truth to that. Mm-hmm. And that comes from the sense that there's a lot of ways in our country, in our economy and our regulatory environment to basically fool people into giving you money. There's a lot of ways to do that. One of the examples in our book is for-profit colleges, right? It was pretty easy for for-profit colleges to convince people that there was a need for a different model of education and to get people to pay up for that, right? But they offered nothing. So while they were very able to make money on the front end, their business model was completely unsustainable because it actually offered no value to the customers. It was a completely extractive effort, right? So, there was probably a time in our country's history or our business history or economic history where you could get away with stuff like that because there wasn't there wasn't the internet. There wasn't sharing of information. People who were sort of messed over or screwed over by a company weren't, they would keep quiet about it because they were kind of embarrassed by it, right? But now everyone has outlets. Everyone shares that information. The media has access to that. So, it's really a lot harder for those kind of companies to actually succeed. So you definitely would not have wanted to invest in one of those for-profit colleges because you would have lost all your money. So.
I put all my money in Trump University. I did. Now I'm a lawyer.
That was
You can't get clearance to secure documents.
So I have a question that's sort of tangential to what you just said there. Leading up to the last Pride season, 2023, and Dylan Mulvaney, there was all this pushback from the LGBT community about companies that were rainbow washing. And then we sort of saw a lot fewer rainbow logos this year than we had in previous years. And it seems like after some digging around that companies didn't become less supportive of the LGBT community, but they sort of just tacked their pride support a little bit, probably due to the Dylan Mulvaney and other controversies that came up. But I'm curious, how can LGBTQ plus and LGBTQ plus supportive investors separate the companies that are just rainbow washing, that do just create products that have a rainbow logo over them, versus those companies that actually are trying to serve the community? Are there resources for us to sort of dig in deeper and say, these Chuck Taylors with the rainbows on the bottom are beautiful, but what is actually Chuck Taylor doing for the LGBTQ plus community other than taking my money? I don't even know if Chuck Taylor owns the shoe. It's Converse, right?
Converse, yeah.
Sorry.
Yeah. So, I think the first thing you got to figure out is, well, how do I figure out who is rainbow washing, right? And I'm going to go back to them again because I think that they're really great. But the Human Rights Campaign, the Corporate Equality Index is a great way, right? So, Target gets 100 out of 100. Costco gets 60 out of 100 because they don't provide medical benefits, right? So I would say, no, don't buy a Kirkland brand rainbow flag, right? That's rainbow washing. Right. And so what you really want to do is go out there and find those companies that are walking the walk and talking the talk. They get the 100 out of 100 on the Corporate Equality Index, that sponsor the Corporate Equality Index. There's like 20 companies or something, right? And they're ones that you've heard of and that right? Who's sponsoring GLAAD, right? GLAAD is out there. So there are 3 top level sponsors of GLAAD. Do you guys know who they are? One is Gilead, a biopharmaceutical company, and they also partnered with GLAAD to do HIV awareness campaigns to raise awareness of other issues that were disproportionately affecting LGBTQ. The second one is Procter & Gamble, right? And not only are they a top level sponsor, but they also did a big study on how to get more LGBTQ representation in ads, because they're one of the biggest ad makers in the world. So that was really relevant. And the third one, and I cannot figure this out for the life of me, is Kettle One. Kettle One is number 3. So I don't always drink vodka, but when I do, I'll order a Kettle One, right? And so, but it's looking at those sorts of things. Look down that list of sponsors. Look down that list of the Corporate Equality Index. There are companies that that you've heard of, that you choose to either engage with or not engage with. That's, to me, more important than the rainbow sticker on your window, right? And it's something that is very hard for anti-LGBTQ people to come out with without exposing themselves as being the bigots that they are, right? And so that's, that's where I would say go look, right? And those are the companies that you can either invest in, that you can purchase products from, right? That's, vote with your money. That's what we're talking about.
Ben keeps wanting us to do work.
Yeah. Well, that's what I was just, that's honestly, that's what I was just
I want
going
you
to
to
say.
drink vodka. That's what I want you to do.
Well, what I was just going to say is you have people on the extreme right who blindly make these comments and statements and say this is fact without actually understanding the truth about the matter. Mm-hmm. There is the possibility that it's happening in our community as well. People out there screaming, these companies are rainbow washing, companies are rainbow washing. And an example of this is John and I went to the Out and Equal conference last year in Las Vegas. We walked in, and at the entrance where you check in is the list, is a giant sign with all the logos of all the sponsors. And literally hundreds of companies that were sponsoring this. And John and I are looking at some of these logos and we're like, no way. I never would have expected this company to be here supporting this. And I think that one of the things that does for us or requires of us in the community is that if we don't want to be copies of people who are on the extreme right spouting untruths about companies, about politics, about people, we also have to do our work. We have to do our work and say, okay, right, these companies, and maybe even more so today after what we did see happen with Target and Bud Light and Disney, is that companies are being a little more selective in the way that they give and the way that they work with the community, so that they do it in a way that it's not going to cause the PR nightmare that these things are happening, which that definitely puts the onus on us to say, okay, I was shocked. I'm just going to say this. I was 100% shocked to see that one of the top level sponsors of Out and Equal was JP Morgan Investments. And I was blown away, because I've always had this perception that JP Morgan isn't doing a whole lot for the community. And we started digging and we're like, wow, they are actually at a lot of these major LGBT events, but they're not out there screaming it. They're not painting a big giant rainbow flag during Pride Month. They're doing it in a very strategic way that helps the community, that doesn't actually just blaze rainbow washing.
They are also one of the sponsors of the Human Rights Campaign. Right? So good on them. And if you're going to start investing somewhere and you need a place to go and you're an LGBTQ person, reward that activity, right? Go at least give them a look. Maybe they're the place for you, right? Because I mean, that's the way to get more of it, is to reward the ones that are doing a good job, right? It is not an accident that on the corporate equality index, the number of companies that are getting hundreds has grown exponentially over the last 5, 10, 15 years, right? It is because they see the value in it. And the way that they really see the value in it is when people like you and me vote with our dollars and say, you know what, JP Morgan, I'm going to open an account with you guys because I saw you, right? I see that what you're doing for the LGBT community, and that matters to me.
Are there comparable HRC type organizations for other sustainable investing in initiatives, such as the environment and pollution and all that? Is there other resources that I can go to if I don't just care about the LGBTQ plus community, but I also care about the environment, children, fair pay, and all that?
Yeah. So go ahead, Kyle. If you want
to. Certainly one that we reference quite a lot is asyousow.org. They have something called fossilfreefunds.org, I think. And you can, if you have a retirement plan and you've got a fund in your retirement plan, you can go to that site and just enter the name of that fund into their little search bar, and it'll give you a report about what their take is on the investments that are in that particular mutual fund, and how they kind of stack up as in terms of, fossil fuel usage, or how they score on that front. They have multiple different trackers like that. I think that's probably the most accessible one that is free for people to use. I know advisors have a lot more kind of tools like that. So, you can, if you have an advisor and you want to talk to an advisor about it, you can ask them about things like Ethos, which uses the HRC information for their scores. That's certainly one way to go about it. Ben, do you have other thoughts about that?
No, I would say As You Sow, SOW, As You Sow, is a great place to go. They even have some gender lens things and things along those lines. So that's a good way to sort of look at it from a fund level. From a individual company level, there are a number of different ratings agencies out there. Two free ones that you can use is MSCI provides one. So you can just Google the MSCI ESG screening tool. And through Morningstar, there's Sustainalytics, where you can go in there and you can type in a company name and sort of see what they have to say about the company from a broader ESG perspective.
Yeah,
Nice.
if what you want is like a high level overview, we offer these fund manager profiles where we don't talk about individual funds, but we look at companies like Vanguard or Impacts, and just give you a sense for what their strategies are, what their approaches are.
Yeah, I saw a commercial yesterday, and I was trying to figure out who the brand was. But there's this man and woman sitting at a coffee table. They both have their coffee, and the man is supposed to be the financial advisor, and the woman is the investor. And she makes some comment to the advisor: is there a way for me to take a company out of one of my funds if it doesn't align with my values? And the advisor looks at her and says, "I'm not a barista." Which I love that. But it sounds like, Ben, what you're saying is we both said, As You Sow at a fund level could tell me what how I guess
how exposed you are to fossil fuels, to weapons manufacturers, to alcohol and tobacco companies, to whatever it might be.
And honestly, it's kind of fun. It's kind of fun to just plop a name in there and just be like, oh, look at that.
Yeah. So that's mutual funds, ETFs, and does that also do managed accounts, or is that a little bit?
I don't think that that's necessarily part of their system, because managed accounts can be done a little bit differently, but it kind of depends on that account. Like some of those accounts are built off of publicly available funds, and then you can kind of look at the
dig deeper
equivalent.
More work.
Yeah, exactly.
I know.
That's the thing. That's the thing that advisors say too, right? It's like, oh, it's another thing to do. It's another.
What am I paying you that 1% for?
Yeah, exactly.
I'm gonna ask a completely not a kind of off script question here, because I think it's something that maybe we as consumers and investors need to think a little bit more about. We oftentimes poke the finger at fossil fuels, which then turns us in the direction of the oil drillers and those companies. But we don't do kind of the same thing when we think about all of the other products that come from those non-renewable resources, cosmetics, the packaging,
fashion,
clothing, all of this stuff. So if I say, is it disingenuous for me to say I'm not going to invest in ExxonMobil because they drill for oil and they're a fossil fuel producer, but at the same time I'm okay with using these cosmetics, or I'm just going to go to Procter & Gamble because I know a lot of their products are in non-recyclable plastic containers. How do we balance that, or how do we check ourselves and say I'm being genuine in my concern?
So I can tell you that people like fund managers who are investing in this way, they absolutely ask those questions,
Good.
right? So there is something called I'm going to get the name wrong, but it's SASB, some sort of accounting standards, sustainability standards board. And they are very focused on what's called materiality, right? Which means what you're doing, does it actually matter for your business, and does it actually matter for the world? And when they look at cosmetics producers, one of the things that they look at and they ask all these companies to report on is your use of palm oil, right? Because palm oil is one of these things that's really controversial and bad for the environment. They also ask you to report how much of your packaging is recycled, right? Or is recyclable. And so, believe it or not, if you go on the Procter & Gamble website, if you go on any of these websites, they're going to have their SASB report, and they're going to say, here's how much palm oil we use, here how much of it you went through this different supply chain, here's how much recyclability, materials we use. And these fund managers can look at that and incorporate that into their evaluation of the company.
Yes.
Nice.
So,
one other thing I think you can say about this is that it's never harmful to raise these questions.
Yeah.
Never, ever harmful. Realistically, there is no world where we can snap our fingers and eliminate 100% of fossil fuel related products. That's just not realistic because it's in everything. The only way that that's going to happen is over time and with a consistent demand that we make those changes, right? So it is true that today, like I say, I like to think in terms of the ladder of impact. There's a top rung out there, but the only way that we get to that top rung is to climb the rungs beneath it, right? So those rungs look like, well, I'm not going to invest my money here, or I'm going to boycott a product or a company where it's obvious to me that there's a problem. You're not required. You're an individual investor or a consumer. You're not required to understand everything in the world about everything in the world. But your voice and your actions and any comments that you put in social media, it raises these questions that companies cannot then ignore, right? They have to do better. One thing that I'm looking for, and that I think I'm beginning to see, particularly in Europe, where they're a little bit ahead on this curve than we are, is when companies start competing with one another over being better about answering those kind of questions, right? Like it's, like the momentum has to come from the consumer. It has to come from the bottom up. And then at a certain, and these companies, what I like about ESG investing is that you invest with these ESG managers. And then when they go talk to the companies, they have to ask the questions that you're asking. They need to get answers. And that means that these companies need to have answers, and they have to have better answers the next time than they do this time, right? So, it's a long game, but continuing to just express your values and express your concerns is what kind of keeps the wheel turning.
I love that too, because we've mentioned this whole idea of the work, and we're lazy and the advisors are lazy. Okay, this is the person who's going to do the work. Fund managers are going to go do the work for us. So let's let the fund managers go do the work for us. But how do we do that?
100%.
We have to invest in ESGs, right?
Right.
Unless we do that, we're basically saying, I'm going to do all the work myself, and then you better do the work yourself.
I'm telling you right now, do not go look at a SASB report. It is not going to be worth your time. All right. Pay someone else to do it for you.
or it could help me fall asleep at night, maybe.
Oh, absolutely.
Good bedtime reading.
It's melatonin, on the page.
I love it. I feel like we could probably continue this conversation for hours, and unfortunately we don't have any vodka here with us, so we probably can't do that. So I'd like to wrap up, if you're all cool with it. If you mind telling us a little bit about your book that's coming out mid-October, I believe, Till Investors, Experts in Sustainable Investing.
Absolutely love to. Yeah, we're super excited about it. What we're kind of in the same kind of camp as you guys. We are educators, communicators that are really interested in the worlds of investing in sustainable business. And, we have a separate business where we do a lot of that kind of content work for different kinds of companies. But we Ben and I are both really interested in trying to close that gap, that knowledge gap that we talked about earlier. So we kind of felt like, between he and I, we have a lot of knowledge, and we're very aware of what's sort of going on in behind these curtains. So we wanted to take it and put it into a book, and an easy book, a short book, something that people could absorb pretty quickly and get a really good grounding on, like, just what the key issues are. So we're very, very excited. It's coming out in October. And we can't wait to sort of, tell everybody all about it.
Nice.
Awesome.
Is it more for individual investors or more for those in financial services, financial advisors?
It's for individual investors.
Okay.
And we were pretty intentional about that, because honestly, if you talk to the investment world or you talk to big money people, they already know this stuff. I mean, that's the thing about it. Like, large institutions and wealthy individuals, they're way down the road. They have access to all these tools and information and advisors who respect their wishes, and are finding different ways to invest their money that way. But for whatever reason, that knowledge and information has not filtered down. So, that's what we're doing here. We're trying to push that information down to a larger audience that can use it.
Well,
It's really like you guys said with your work. We're trying to build confidence, right? We're trying to help people feel like, oh yeah, this is a thing I can do. I know it matters. I just need to, have a little bit of self-confidence and feel like I'm educated enough that I can just make my first investment, right? Go into my 401k and find the ESG option and click yes, right? So that's really who we're after.
I also say, to what you were saying, Kyle, maybe what we need is one of those really big investors or those really big fund managers to tell Ron DeSantis to shut the fuck up. You don't know what you're talking about. These are the numbers.
I think isn't
and
the
this is why
CEO,
you're wrong.
the CEO of Disney's been saying that. Right? I can't.
Well, yeah, but
let's.
let's go with the DE&I or the ESG investing space.
The anti-ESG thing is such a self-own. It is unbelievable. They are costing themselves, and I'm being serious here, millions and sometimes billions of dollars by saying we're not going to invest with BlackRock because they're blah, 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 right? They're the cheapest. And these states are just, like I said, an incredible self-own.
Yeah.
Yep. Bye.
Well, Kyle and Ben, thank you so much for joining us. We look forward to your book coming out, and we look forward to possibly having you back. I think we have some other topics we need to dive into.
Yeah.
Awesome. We'd love to come back and chat. Maybe
Great
with vodka
talking with
next
you.
time.
Thank you. Absolutely. Start your journey to financial independence with a checking and savings account that doesn't nickel and dime you with fees. Get a Capital One 360 checking or 360 performance savings account at Capital One today. Thank you, Kyle and Ben, for shedding more light on sustainable and ESG investing. Thank you, our listeners and viewers, for joining us for another episode. Here's your Queer Money takeaway. Look out for Kyle and Ben's books, Sustainable Investing and ESG Starter Kit for Everyday Investors, coming out mid-October 2023.
Then join us this Thursday when we share the most affordable LGBTQ plus friendly city to live in Michigan. And next Tuesday when we share the best retirement calculator that we've found from our longtime friend, Lauren Boland. Thank you and have a great week.